Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this Sunday morning. If you have questions about your portfolio, if you have questions about the advice you're receiving, how to pick the right advisor, how to understand fiduciary suitability, how to know when to sell, any of those questions, send them to Brian Rezny at ReznyWealth.com. You can also visit our website, ReznyWealth.com, for a lot of great information and free reports that are perfect for retirees and pre-retirees alike. Also, you can visit our website and check out our upcoming workshops, Adapt for Success, how to build, how to save, how to prosper in any economy. If you want to know more about investing, if you want to know what not to do with your money, and more importantly, what to do with your dollars, go to my website, ReznyWealth.com, and attend one of our upcoming workshops throughout Florida. You'll learn a lot. They are perfect for pre-retirees and retirees alike. You know, today's topic is about, I'm going to talk a little bit more about investing strategy, behaviors that hurt investors. I also want to talk a little bit about the U.S. economy. You know, we receive a lot of calls and questions, not only on my TV show, but also my live radio show, additionally on Sunday mornings. Investors are concerned about, is the U.S. economy doing well? What do you need to look at for recessionary purposes? And a lot of questions in regard to a market crash, like what we saw in the year 2000 and the year 2008. One of the things that I stress to every investor is this: not only do you need an investment strategy and you need to follow it, but you need to have a way to minimize catastrophic risk, like in the recession of 2000 or 2008, when the equity markets dropped over 50%. Ask yourself this simple question: are you managing the risk in your portfolio? And is your advisor actually managing the risk in your portfolio? I can tell you statistically, I've been managing money for 28 years. Most advisors are not really advisors at all. They're Wall Street companies, banks, and insurance companies that are really just selling products their brokers with fancy titles are required to sell and their firms manufacture. They don't actually manage your money under most circumstances. Unfortunately, most people think they do. If you're self-managing your own money, what is your exit strategy? When do you sell? The number one risk to a portfolio is large drawdowns of 30, 40, 50% like in a recession. Recessions come and go. We look at key indicators at Rezny Wealth Management when we want to start reducing risk when the economy starts to falter and actually slow down. Right now, our indicators are not showing signs of recession, so generally speaking, we're fully invested running a strict strategy, but we always look at daily risk management for every client. At our upcoming workshop, Adapt for Success, Investing for a Safe and Secure Retirement, we're going to be talking about our key strategies to reduce risk from a recession and how you can look at recessions and protect your portfolio from those catastrophic losses. Go to my website, ReznyWealth.com, for more information, valuable, great information for your retirees and pre-retirees alike. I want to start off today, though, talking a little bit about investing and investing strategy and what really hurts investors. Fixing bad investment behaviors is key. What works and what doesn't work in investing? Too often, too many investors, first off, do not have an investment strategy, nor does their advisor, because again, you're working with a Wall Street firm, broker, or bank, and you're working under suitability and you have a brokerage account. But most people falsely believe that broker is actually watching and managing their money, and all they're really doing is selling you investments. So at the end of the day, what works and what doesn't work? At the end of the day, you need to understand the disposition effect. This is one of that I find often investors hurt their portfolios with huge losses. The disposition effect is fairly simple. It's the tendency for investors to hold losing investments far too long. Let me explain. You go and buy a stock. Let's say it's Enron. Many of you maybe remember a firm called Enron back in the 90s. It was one of those must-have stocks. Well, Enron turned out to be basically a big Ponzi scheme, and the company went bankrupt. But investors jumped into the stock because it was going up, but they never had an exit strategy when to sell. So a typical disposition effect is this. You buy a mutual fund or a stock, or somebody sells you a variable annuity, and you put your money into it. It's like going to Vegas. You let it ride. That's a mistake. So you buy a stock at $80, it drops down to $70. You don't want to sell because you're down. You're going to wait till it comes back, then sell. But then it drops to $60 and $50. As it keeps dropping, you don't sell because you want to wait till it comes back. You need to have a way to mitigate losses, catastrophic losses, and too many investors don't have a strategy they follow, nor do they have a risk management strategy or when to sell. Disposition effect hurts a lot of investors, and if you don't get rid of that emotional ties to investments, you're going to lose more money, chances are, than you'll ever make. Focusing on past performance with mutual funds and ignoring fees. Now, not just mutual funds, but any investment. But the bottom line is this: investors are plagued by the media. You get these magazines every year, every month, the top mutual funds to buy now or the top investments to buy now and hold for the next year. I can tell you this, folks, buy and hold does not work. It didn't work in 2000, it didn't work in 2008. It doesn't mean you should trade every day, but there's times you need to actually sell certain investments. But investors will buy based upon past performance. What did the best the year before? Or your portfolio, let's say, is structured where 10 investments are in there. 4 didn't do that great, but 6 did really well. Most investors want to put more money back into those winning investments when maybe you're better off rebalancing back to some of the areas that underperformed if the fundamentals show signs of improvement and possible future gain in your portfolio. Familiarity basis. This is a big one. What this basically means is you, the investor, tend to favor investments you've heard about or that are in your general own country. Great example. 95% of investors have about 95% of their investments typically in U.S. investments, whether it's stock and bond. They never look at other investments around the world, nor do they look outside of stock and bond investments. There are many investments that can complement a portfolio and reduce risk and maybe even increase your retirement income that are not related to stock and bond. But most investors, again, buy what they're familiar with versus what's appropriate for their portfolio. By the way, Wall Street loves to sell you things that you're familiar with because that's an easier sale than selling you things that maybe are more proper for your portfolio or lower cost structure. Naive diversification. Too many investments, essentially the same asset category. I can tell you in the last 3 or 4 years, Wall Street has been pushing big that pie asset allocation. It's kind of spread it everywhere and set it and forget it. The problem is that set it and forget it really is just in 20 or 25 different mutual funds, and most of them own the exact same investment. So you have no real diversification. You're owning the same thing and the same thing and the same thing. You're just layering up the same investments and creating more fees. You think you're diversified, but ultimately everything kind of goes down at the exact same time. Noise trading. This is the emotional problem a lot of investors face. Every day, you, the investor, are plagued with tons of news. Whether it's the TV, the radio, print ads, it doesn't matter. All day, every day, this is going on. The world's coming to an end. The stock market's crashing. The bond market's being hurt. You hear all these crazy headlines. People react to that. I can tell you at Rezny Wealth Management, we put none of our decision making, none, into the news media and stuff you hear on the news. None. I've been managing money for 28 years. I can tell you that if you follow the media and you emotionally trade or make decisions off what's going on in the world after it's happened, you're going to be a loser in investing. You're going to make lesser returns and you're going to create more risk in your portfolio. Too many investors listen to the news, they emotionally trade off of that because, again, they don't have a written investment strategy they follow, which includes risk management. That's a problem for your portfolio and for your retirement. Go to ReznyWealth.com and make sure you send me your email questions to brianrezny@ReznyWealth.com. Also, go to my website, download any of our free reports. Also, check out our upcoming workshops, Adapt for Success. Perfect for you retirees and pre-retirees alike. If you're concerned about your retirement income, if you're concerned about the advice you're receiving, if you want to know how to protect against the next recession and major market crash, we teach you all that and a lot more. This isn't one of those Wall Street seminars, the pitches to sell you a product. This is hardcore educational information you can understand, and we want to help you profit and reduce risk in your portfolio. So go to ReznyWealth.com and check out our upcoming Adapt for Success workshops throughout Florida. Andrew in Fort Myers, Florida. I only have $150,000 to invest. I can't afford to lose it. I'm investing in high-yield preferred stocks. Does that make sense? Andrew, high-yield preferred stocks have risk. All investments do. But your comment about you can't afford to take risk and you're putting all your money in preferred stocks. Preferred stocks are a hybrid of stock and bond kind of related. And they can have as much volatility as the stock market. So for you to say you don't want to take risk, but all your money's just in preferreds, you're taking a huge risk. Preferred stocks act very much like long-dated bonds, meaning if rates go up, you could lose a lot of principal value in preferreds. Also, preferreds can go down in recessions just like common stocks can. So you are taking a ton of risk, and you're only on one little asset category in all the hundreds in the marketplace. You're taking way too much risk. I would suggest you visit our website, download any of our free reports, and really learn about investing. One that I would say would be great for you is how to avoid outliving your money during retirement. It talks about risk management, and not running out of money during retirement. Schmidt from Bonita Springs, Florida. What is your opinion of municipal bond closed-end funds? They took a small hit in the past week. The yields on these CEFs are reasonable. Schmidt, great question. First off, closed-end mutual funds are more complicated than a lot of other investments. I would rather have you look at what's called an ETF, exchange-traded fund, instead. The problem with most closed-end funds is they deploy leverage to juice up what appears to be a dividend or a yield. But often this is called distribution. The distribution could be return of your own capital, but people don't understand what distribution and yield really means. So you look at something, let's say paying a 6% distribution rate, you think you're making a 6% yield when maybe 4% of that money is your own money being returned back to you, and only 2% is actual return. Also, these funds deploy leverage. Leverage creates risk. Most closed-end mutual funds I do not like because they're far too risky, they deploy leverage, or they're trading well above net asset value. They are more complicated to research, so don't just think because something's down a little bit and it looks like it's paying a decent yield. It could be distribution rates, and it could be far riskier than you realize. Eleanor from Marco Island, Florida. I would like to put my husband's IRA and my IRA account in the best dividend-paying stocks and use the dividends. What do you think? Eleanor, statistically speaking, it's very hard for individuals like you or any individual to have the time, discipline, or talent to pick a basket of individual stocks. And by just putting all of your money into dividend-paying stocks today doesn't mean some of those stocks on a yearly basis may not need to be sold and changed up. Just putting your money in individual stocks creates a lot of risk. Dividend stocks don't necessarily pay the highest total return. Total return is gain of portfolio and the dividend you receive, or loss of portfolio and dividend you receive. You as an investor have to realize this. Picking individual stocks is hard. I would prefer you look at exchange-traded funds. They're low cost. They don't have the shenanigans of mutual funds and other investments that Wall Street concocts. And you can own any asset category, whether it's real estate, oil, stocks, bonds, gold. Any asset category pretty much is available as an asset category specific in the ETF format. A well-diversified portfolio on a total return strategy, in my opinion, Eleanor, is much better than you picking a basket of 20 individual dividend-paying stocks. Do you have the time to spend 20 or 30 hours a week researching those stocks continuously and knowing which ones over time need to be sold? Buy and hold doesn't work, and it doesn't work with individual stocks. Every investment needs to be researched, and there may be a time, whether it's next week or 10 years from now, that some of those investments may need to be sold. Picking stocks is hard, and I can tell you from 28 years managing money, most individuals that try to do it themselves get frustrated, they make lower returns, take more risk, and lose ultimately a lot more money than they thought they were going to. That hurts your portfolio. I have to take a short break. Visit my website, reznywealth.com. Check out our upcoming workshops, Adapt for Success, perfect for your retirees and pre-retirees trying to increase your retirement income and grow and protect your portfolio. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back. I hope you're enjoying today's program. As we do every Sunday, we take your questions, so make sure you do send your investment questions to Brian Rezny at reznywealth.com. You can also visit my website, reznywealth.com. And of course, if you're not happy with the advice you're receiving, you're realizing you really don't have a real money manager, or the firm you're utilizing really is just full of conflicts of interest and bad advice, call us for a consultation. We deal with high net worth individuals with a minimum of $500,000 to manage on up. So if you're concerned about your portfolio, if you want to go through our proprietary 21-point investment and retirement analysis that can look at the key strategies maybe you're not taking advantage of, whether it's on increasing retirement income, protecting the retirement portfolio, or reducing taxes, call my firm. The number's at the bottom of the screen. And also you can visit our website, reznywealth.com. Make sure you do check out our upcoming workshops throughout Florida. Adapt for success, investing for a safe and secure retirement. Pam from Miami, Florida. What do you think about the Apple split? Is it a buy? Are splits good for stocks? Generally speaking, Pam, splits are not good nor bad for stocks. If you look at the long-term nature of stock splits, just because a stock splits doesn't mean the price is necessarily going to go up. Sometimes they go down. What drives stock prices is earnings. So if a company is selling more goods and that translates into higher earnings, generally speaking, it gives that stock a chance to go to higher prices. Because remember, there's something called the PE, price to earnings. Generally speaking, stocks will trade in a certain range based upon a PE ratio. As earnings continuously grow, you have an opportunity for that stock to go higher. If earnings are shrinking, typically that's a company that's not doing well, of course. Their revenues and sales are going down, earnings are going down, that stock price goes down. For a company like Apple, their sales are growing, their earnings are growing. As long as they can keep on that track and the stock is not overvalued based upon various metrics in the industry, it may be an opportunity for you to buy. But never buy a stock just because it's split. That doesn't mean it's good nor bad for the stock price. Bill from Naples, Florida. With the market trading at close to a new high, should I be selling? Bill, just because the stock market or any investment is trading at a new high doesn't mean it's a reason to sell. Sell criteria usually comes in because things are changing fundamentally with that investment, and the reasons you bought it are changing to the negative side. That would trigger a sell. The stock market, just because it's trading at a new high, doesn't mean it's not going to trade at a new high over the next 3 years or 6 years or 10 years. If you look at statistically, the stock market's kind of like walking up and down stairs. It goes up 4 or 5 steps. You might get a recession, it comes down a step or two. It goes up another 8 steps, comes down a step or two. You're going to get that. Generally speaking, the U.S. economy is growing. Things look pretty good on earnings so far that we're seeing that are coming out so far for 2015. Generally speaking, the trend of the U.S. market is looking good. There are certain sectors that are much better than others. We primarily like some of the areas in the small and mid cap, more so than the overall large cap in the U.S. We're avoiding a lot of the countries outside the U.S. because of some of the problems they have with the growth of their economy. So again, do your own homework, but generally speaking, we like the general trend, we like what's happening, but we look at this stuff every day, and if we see faltering in the U.S. economy, slowing or negative GDP, that would give us a reason maybe to start raising cash and getting more conservative within our managed accounts for our clients. Roger from Fort Myers, Florida. What if your company's 401k plan is lousy? What should I do? The problem with most 401k plan, Roger, is most of them are not that great. They have very limited options, and the investment options they often have are usually expensive and just basically kind of all the same thing. So what you should do is this. If you can not take the money out of your plan, do the best you can with the options within your plan. If you can take the money out, some companies, even though you're still working for them, will let you do what's called an in-service transfer to a self-directed IRA account. If you're not working for that company anymore, or you have a leftover plan from somebody else, definitely trustee to trustee transfer that into a self-directed IRA, because now you have unlimited investment options. You can build a real strategy or hire a real investment firm like Rezny Wealth Management to actually manage the money for you and also provide risk management. So the bottom line is do the best you can with what you've got, but at any point you're allowed to take an in-service transfer to a self-directed IRA, or if you've left the company, that's the best opportunity, in our opinion, for somebody who has money at a company or a past employer. Mary from Cape Coral, Florida. I own 4 variable annuities from Allianz. 2 are IRAs and 2 are individuals. My advisor is recommending I transfer them into an equity index annuity with security benefit and Aviva. What do you think? First off, Mary, I do not like annuities, period. Go to my website, download my free report, Why Annuities Are Dangerous to Your Wealth and They're Dangerous to Your Retirement. Annuities in general are sold under suitability for big, lavish commissions for your broker. By the way, the person selling you those annuities is not an advisor any more than my pet lab is. Your annuity salesperson is a salesperson, and that is it. He or she wants to sell you what is best for that person to basically generate another commission. Annuities are ladled with fees. They have huge back-end surrender penalties. They get all your money out. The expenses rob your returns. Don't buy an annuity. What I would suggest you do, go to my website, download that free report at reznywealth.com, or call my firm for a consultation. Stop working with a salesperson that's selling you the annuity of the month. Work with a real firm that can help build a quality portfolio, help manage the income, the growth, and the risk management of your portfolio. Don't buy an annuity. Don't be sold down the river. Joan from Fort Lauderdale, Florida. Can you explain fiduciary versus suitability? That's a great question. Again, you can go to my website, download our free report for more details on fiduciary versus suitability. But I can tell you this, 90% of investors falsely believe their advisor is actually a real advisor or money manager, falsely believes that their advisor actually has to work in their legal best interest. Most so-called advisors, whether it's a Wall Street firm, bank, or insurance company, work under what's called suitability. Suitability basically means they only have to sell you investments that are suitable based upon your goals and objectives. They could be lousy investments, they could be expensive investments, and suitability's been met. Under suitability, they don't have to legally work in your best interest, nor do they. Under a fiduciary advisor, under a fee-only fiduciary advisor like Rezny Wealth Management, we're required to work in a legal best interest for the client. We work for our clients. We don't work for a bank. We don't sell sponsored products. We don't create products that line our pockets. We legally work as a money manager for the client. So go to my website, download our groundbreaking report. It's your #1 investment and retirement risk, fiduciary versus suitability. Again, 90% of investors are making this costly mistake. They jump from broker to broker, or so-called advisor or wealth manager to wealth manager. These people use fancy titles of deception. Read it. Do you have a salesperson in a suit, or do you have a real money manager, a fee-only fiduciary? Find out the facts. Go to reznywealth.com. Rob from Miami, Florida. Gold, silver, and gold stocks have taken a beating in the last 3 years. With these rock bottom prices, is now the time to invest? Rob, no. Just because a specific stock or sector is way down doesn't mean it's necessarily a buy. I am not a big believer in gold and silver over the long term. There's really no real investment thesis for it. Generally speaking, gold is sold on the emotional, the world's coming to an end scenario, that we've got hyperinflation and you have to own gold, and then we're going to have all these geopolitical events and you have to own gold. Well, guess what, folks? If you look at gold prices, they're down like 35% over the last 3 years or so. We have a lot of geopolitical events and gold's still down 35%. We have really almost no inflation, of course, so gold is going down. At the end of the day, gold is a traded investment. If you're good at trading, then maybe generally speaking, and you can build a strategy on trading gold, knock your socks off. But just because an asset's down doesn't mean it's going to rebound. I also look at base commodities, and I look at how those have been down the last 4 or 5 years. Again, just because something's down 30, 40% doesn't mean it's a buy. It needs a catalyst on a long-term structure to change to push that price higher. As always, visit my website, ReznyWealth.com. Send us your questions for our next show at BrianRezny@ReznyWealth.com. And remember, I do have a live radio show every Sunday from 10 a.m. to noon throughout Florida. You can also check out our Adapt for Success, Investing for a Safe and Secure Retirement, perfect for you pre-retirees and retirees alike. If you're concerned about the advice you're getting, if you're realizing the person that you're trusting with your money does not have an investment strategy, does not manage the risk, you're concerned about a market crash, go to my website, download any of our groundbreaking information, and check it out. You know, I want to leave you with this. The economy in the U.S. is doing well. A lot of the European economies are doing poorly. If you look at the growth potential, if you're trying to grow your money and ultimately protect your money, be in the area that is strongest fundamentally and strongest on a relative strength basis. Relative strength measures the performance of various sectors. Relative strength has been a proven strategy to gain return on a portfolio. Relative weakness, downtrends, have been proven to reduce your returns and create more risk. Never ever buy an investment category in a long-term downtrend, like one of my questions on gold. Always look at trends that are positive. You want to buy into a relative strength positive trend because that's the best opportunity to grow your portfolio and also for income. Now, while interest rates obviously are down, we have an opportunity for rates slowly to move back up if the economy continues to do well. If you have too much money in bonds, one of the biggest risk categories in our opinion today, and overvaluation generally speaking, is the bond market. Make sure that you're doing the right thing with your bond portion of your portfolio, and make sure that you are not sold an annuity or expensive investment products through your brokerage firm, bank, or insurance company. At the end of the day, bad investment advice doesn't fix itself. It's really up to you to make wise decisions. Go to my website, ReznyWealth.com. Again, check out our Adapt for Success investing workshops. Send your email questions to BrianRezny@ReznyWealth.com. Better yet, call my firm for a consultation. There is a difference. We invite you to experience it. I'll see you next week.